Thank you, Carmen. I feel like I'm so fired up. There's so much that I want to do. I'm following up with many of you. I want to make intros. This is really, really exciting. So thank you again, panelists, for the great discussion. Welcome again. We're a very welcoming team, right? Inclusive in all aspects, but welcome again to the 8th Annual Hispanic Heritage Foundation Investors Forum. If you're just joining us, we do want to take again the opportunity to thank our sponsor, TIAA Institute, for their continued support. And we are thrilled to share that we are adding a fireside chat later this afternoon with Samara, Monica, and Stacy. Is going to be on fire. So please make sure that you check the link on the chat for more details. Up next, we have the Technology Investing Growth Panel. Joining the panel, we have technology investors that will give an update on how they are navigating a boom in their sector. Investors will discuss how they execute their investment strategies despite the record valuations and deal activity. And moderating the panel, another great friend, Cheryl Campos, Head of Growth and Partnerships at Republic. I have to say, Republic was one to believe in me, so I raised capital for my community through your platform. Thank you for joining, Cheryl, then take it away.
Great. Thank you so much for having me, guys. And, this is going to be an amazing panel. We have a star-studded group who are really experts in the space and really run the gamut between early stage as well as late stage. So you'll get a full view of viewpoints in the following 3 trends. So investing trends, access to capital, and long-term economic inclusion and generational wealth. So if you have any questions, please feel free to drop them in the chat so that people can respond. And I'll start off introductions with just my background. Cheryl Campos, I am the moderator for this event, as well as head of venture growth and partnerships at Republic. As Martha mentioned, we allow anyone really to invest in this asset class. So, retail investors, accredited, non-accredited, into top tier companies. And so not only that, but I am an investment partner at the community fund, as well as a co-founder of VC Familia, which is a community of over 150 Latino venture capitalists that are, supporting current and emerging investors. So super excited to be here. We'll start off with quick introductions. In alphabetical order. If you guys want to also drop in your Twitter or LinkedIn, please feel free to do so in the chat so that people can connect. We'll start with Adriana.
Hi, everyone. Thanks for being here today. Hi, Cheryl. Just to share my background quickly, I was born and raised in Ecuador, came to the US for college and stayed here. I'm currently an investor at Clock Tower Ventures. We're a fintech-focused VC based in LA.
Great. Alejandro?
Thanks, Cheryl. Hi, everyone. It's nice to be here with you all. I'm Alejandro Guerrero. I'm a co-founder and general partner of Act1 Ventures. We are a seed and pre-seed fund here in Los Angeles, investing exclusively in business software. First generation Mexican-American. Parents are the tried and true immigrant story, dropped out of school as adolescents and immigrated to America looking for a better life. So a bit different than the typical VC that you'll see outside in the world. We manage about $65 million now in assets between a fund 1, a fund 2, and then a bunch of SPV follow-ons.
Great. Uh-huh.
Guys, it's Cheryl. It's a pleasure to be here. My name is Angel Sad Gomez. I'm a venture partner with Oak VC. Professionally, I'm focused on taking some of my companies public. Personally, I've been testing a few interesting hypotheses over the past few years, and some of them have turned out pretty good with some unicorns. As far as background, I'm the first one in my family. I came to the US when I was a teenager. I was the first one in my family to get a degree from the United States. I was very, very fortunate to be able to go to Stanford for undergrad and a Wharton MBA. I'll be posting my link for LinkedIn for anyone to reach out if they want to connect, and please put HHF somewhere in there so I can recognize and prioritize it. Thank you.
Amazing. Jasmine?
Hi, everyone. My name is Jasmine Medina. My parents are hardworking immigrants from Mexico, first in my family to go to college. I will also post my my information, so please, everyone, do the same. Please tag this event, and I'd be more than happy to connect with you. I'm currently a principal at Newview Capital. We're a mid to later stage spin-out fund from NEA. We manage about $2 billion in assets, and we invest in enterprise SaaS and fintech.
Amazing. Rami?
Hi, everyone. My name is Rami Reyes. I was born and raised in Miami, raised by a single Nicaraguan immigrant mom, fortunate enough to get a scholarship to go to Wharton and then get recruited out of college by the Elevation Partners team. Started the first 5 years of my career at Elevation Partners, which was a large late-stage VC and PE fund, and then spun out in 2015 and co-founded Next Equity Partners, which is a mid-stage fund focused on consumer tech and enterprise software companies with 10 to 50 million in revenue. And I started that with the former Apple executive team who I worked with at Elevation. And I'm also the president of Latinx VC, the Latino VC Association, working with a lot of the individuals on this call on impacting positive change in our community.
Great. Last but not least, Rebecca.
Hi, my name is Rebecca Huang. It's an honor to be part of this panel. Born in Korea, raised in Argentina, educated at MIT and Stanford in engineering. I'm the managing director and co-founder of Calais Ventures, which is a fund in Latin America investing in early stage startups. And prior to that, I also co-founded another fund called Rivet Ventures, which invests in companies that have as a main demographic female consumers in the US.
Love it. Thank you so much, everyone, for the introduction. So we'll get right into it. First theme is investing trends. So activity in the early stage has accelerated due to the pandemic. So in terms of remote funding or remote work, and it's easier than ever to create a startup. So how has your thinking changed after the pandemic on funding companies at the earliest stages, especially as we start going back to in person? We'll give this off to Adriana and then Alejandro.
Perfect. Yeah. So just to start off, quarantine really was the fastest period of investing we've ever gone through as a fund, and it truly surpassed our expectations in that sense. I think there's a lot of learning. One of the most important ones is that nothing replaces human contact, and we're very eager to go back and be on the field. But there has been a lot of things in the way we've found opportunities and collaborated with VCs that I think validated our model and gave us more conviction on how we're doing things. I think first and foremost, we only co-invest in very lead rounds. So we've always positioned ourselves in a very friendly dynamic with VCs and startups. And therefore, I think quarantine allowed us to become even more collaborative with other VCs. And not just in due diligence in terms of helping each other get faster and fill the gaps that we couldn't have filled individually given the new normal. But then most importantly, serendipity didn't exist anymore, right? So there weren't any more conferences, nor ways for founders to get in front of VCs in a more organic fashion. And therefore, we tried to play a very unique role in syndicating rounds more proactively than ever before and leveraging existing relationships to help founders get in front of more VCs and close bigger rounds or find a better fit. We learned there's a lot of power in doing that, and now we're staying true to that mission and way of doing things. And I think those have been the core learnings. And then just acting as unconflicted advisors also in the way for founders and helping VCs also find the best matches as well. And I think that's a key point.
Great. Alejandro?
Yeah, look, I think there were some positives that have evolved in the venture ecosystem, particularly at the earliest stages with the acceleration of trends with the pandemic. Look, at our firm, we've always invested in diversity. We're at 40 companies invested now across the fund. 70% of them are led by women and minority founders. So we weren't scrambling and trying to figure out how do we identify women and people of color. We had done the work for that. I think what we took a step back and pause on was recognizing that the pace of everything was moving so rapidly and it was uncomfortable for us, right? We're thesis driven. We're not doing 20 investments a year. Obviously, we were meeting with everybody that we were investing in. And so, because there's a there's just limited data right at the beginning stages. We're really betting on the people and the teams. Do we believe that this team and their experiences give them a competitive advantage to build a product that they've had experience working in their career? We've been able to really expand on that now, right? Because now, through the trends of the pandemic, we're talking to teams that have been outside of some of the more traditional hubs that we've historically invested in, predominantly in Southern California, but also in the Bay Area and New York. But since then, we've gone on to make investments in other areas as well. That included Mexico with a couple of deals there, including in Virginia. So just that ability to continue to find incredible, diverse founders that are not necessarily concentrated in these traditional ecosystems, I think has been a big positive. I think also it's just the ability to work with a broader set of firms has expanded as well. So just tapping into your networks, not really resting on the existing networks as well, but being able to understand that what we lost in terms of in-person meetings, in-person conferences, we needed to find a way to make up for that, because everything in venture is fluid, right? It's living and breathing, and what's cool now may not be cool a year from now. And so you just want to make sure that you're understanding what is going on, and how you do that is by building a tribe, by keeping a sense of the pulse between investors and founders, and obviously the LPs as well that finance the entire ecosystem.
Awesome. So for our late stage folks, which are Jasmine, Rami, and Angel, investing is a bit more formulaic in the sense that there's more information to work with. And so how did investing during the pandemic change, and what will you keep moving forward? So I'll call on Angel first and then Rami. Angel. Are you there? No?
Perfect. I'm here. Excellent. Thank you. It's a great question. Spot on. So in many ways, I've been preparing for economic downturns for quite some time. And I think maybe it's just the background of being Latino or underrepresented or dealing with economic downturns or all kinds of challenges in life that kind of prepares you with that mindset. So from that aspect, I mean, the pandemic was not the shock we expected, but it validated and refined a lot of our thinking and preparation, both from an investment thesis standpoint, but also helping our portfolios kind of navigate and prepare for these kinds of challenges. There's just a few takeaways that we kind of walked away with, right? Like first is the pandemic confirmed our hypothesis in terms of systematic risk and the large role it plays in the venture category. Like a lot of people don't understand that, or feel that because venture is private and it's so long-term that you navigate these cycles without much of a challenge. So the big takeaway is think about resiliency, not resiliency just in terms of the company itself, but resiliency of the portfolio and the role that companies and underlying risk brings to the table from a portfolio standpoint, which ties into the second big takeaway for us, which was, the underlying volatility risk of the private portfolio is often overlooked, but it's super important from a risk-adjusted return standpoint. And this becomes increasingly relevant for LPs, for example, because let's say you have some money in the stock market or public equities. Well, tech has been a huge driver in growth for a lot of these public exposures. Well, if it turns out that your private investments are also growing tremendously because of their technology exposure, you may find yourself in fact, unknowingly perhaps, in a situation where there's correlation creep. And perhaps what tended to be 15% is now 20, 25, perhaps 30% of your overall AUM is correlated to a certain subset of underlying risks. And you don't want to be there, right? Last time I checked, I think December 2020, S&P 500 was like 27% pure technology, effectively the FANGs, right? So as a venture investor, you have a responsibility to your LPs, and the CIOs will be asking this question in terms of how are you ultimately impacted? How is our underlying risk exposure impacting their expected risk and return profile? And the third piece, which I think many of us will touch on, is the fundamentals of venture are more important than ever, especially if you combine some experience with diversity of thought and a tighter alignment with LPs and CIOs in terms of matching some of these risk objectives from a risk return standpoint. And let's think critically about what risk return means as we navigate additional downturns that we'll be facing going forward.
Yeah, so our fund is focused on the mid stage, so companies kind of after where the early stage funds play, and a little bit earlier than where the big late stage funds play. The two obvious things that have happened in the market are one, meetings moved to remote. I think that's not an issue for the initial meeting. I actually think it's a positive because doing a bunch of initial meetings all over Sand Hill and all over other parts of the country is pretty inefficient for founders. So I think the fact that initial meetings have moved remote is a positive. But at the end of the day, you still need to do meetings in person eventually. And so, because you're investing long-term with someone. But we were very comfortable doing some of the meetings remote. Largely, we try to get to know companies early so that there's already that relationship there, which helps with, the second big trend, which we've seen, which is, investment decisions have moved up quickly. In parts of the market, hedge funds have come more aggressively after mostly the late stage, but some of the mid stage as well. And so they're doing less diligence than some funds have historically done and kind of moving a little more quickly. And so that's made more at the late stage, but also at the mid stage, some investments have to move more quickly. Now, our fund tends to focus on what we call underhyped companies. So companies that have venture upside but are a little more under the radar. So we're not seeing as much of that as you do see with kind of the hottest sectors in Silicon Valley. But we are seeing that a little bit. And the takeaways from that are build relationships early, and so that you can get to know a space and so you can move more quickly. And also, you'll have to have fewer in-person meetings because you can do some of it virtually if there's already a relationship there.
Great. And let's stick with late stage folks for a second. So in the same vein, your institutions really range from 120 million all the way to 1.2 billion. And so the space, as we mentioned previously, is really flush with capital right now. It's commodity. So how are you thinking about your strengths as a late stage investor to stay competitive? We'll start with Jasmine and then go to Angel.
Right. So I'll frame the conversation a little bit on two nuances and two things that we really focus on as a fund. One is direct investing. We invest in companies from Series B all the way to pre-IPO. And then we also do direct portfolio acquisitions. So we'll buy baskets of companies from early stage investors, very similar to what we did with NEA. And so the areas that we really try to innovate around are providing highly flexible capital. So we're a registered investment advisor, and few firms have this accreditation. And most don't really use it like the way that we do. Our sort of thesis has been that, capital at the later stage is really flush and companies are staying private longer. They're starting to use this capital in much more strategic ways. You can grow differently through M&A. You can grow differently in ways that you can as a public company. And it's almost a luxury to be able to stay private a little bit longer. And so what we realize is that the secondary market and being able to adapt to what entrepreneurs and CEOs want today is incredibly important. And so we try to have a very flexible mandate, us being able to invest both on primaries and secondaries, and being able to evolve with how the market is as well. The second thing I think that most funds are really focused on, and it's something that we focus on as well, is sort of going back to fundamentals. We really pride ourselves on being a very operational VC. So a majority of our team has some time working operationally at companies and also working on the finance side. It's something that we think is really important, especially during COVID, where you're having first-time founders, you're having CEOs who've never really been through this transition before, and helping them understand how they need to think about their go-to-market strategy during this time, their product strategy during this time is incredibly important. So again, at a time when capital is just a commodity, really being able to be a good thought partner in these times, to Rami's point, with competition coming in from many of the hedge funds, it's really important to understand where you play well and what situations to opt into and which ones, quite frankly, to opt out of that aren't necessarily the best model for your fund.
So great. And as a segue to that, I've had the privilege of working with some of Jasmine's colleagues, super professional people in a portfolio we co-owned together with NewView. On our side, the focus has always been on how do we optimize for risk-adjusted returns? Because, and I think this is very relevant for emerging managers, no one is giving us capital to see how we maximize risk and hopefully get a positive outcome. So to give you an example, right, when we read about some of these sky-high valuations in the news or top quartile fund performance reports, they can be very misleading. And a lot of folks get carried away with that. What's missing in that conversation or that data is what is the underlying risk that the GPs are taking and ultimately passing to the LPs. We've all heard about high risk, high reward, but you constantly only hear about the high reward piece, right? There's nothing about the volatility. There's nothing about the standard deviation. So in private market investments like venture capital, how do you know that the high reward is really a result of statistically significant alpha rather than just riding the beta wave, right? A return can measure it to the level of risk you took. Like no one wants to pay for that, even though most of the time they think they're getting alpha. Really, it's just really nicely packaged beta. So my question every day is, what is the highest reward I can get for the least amount of risk? And how will each additional investment ultimately impact the overall risk profile of my portfolio? A specific example, relevant currently, because one of our late stage companies pre-IPO is in the process of going public through a SPAC. So New Beginnings Acquisition Corp, NBA, like the National Basketball Association and the stock market, the company's Airspan. It's the leading US company in terms of 5G, both hardware and software. It has over 1,000 customers in 100 countries, hundreds of million in revenue. They're still posting over 120% year-on-year revenue growth since 2018 for new revenue. Margins are over 50%. So this all sounds positive and sounds like, oh, great company, etc. Where I find this to be the most interesting opportunity from a risk-adjusted standpoint is that it's playing in a category that has a beta of 0.5 and 0.6, more or less, average. So what that means for the non-technical folks, which is completely fine, a beta of 0.5 effectively means that the company is expected to give you a return that is about half of what the market is returning, whether it be upside or downside. So if the market loses 1%, you're only expected to lose half a percent. And if the market earns 1%, you're only expected to earn 0.5%. Generally, you'd consider that stocks or companies that have a lower beta, less than 1, you call those defensive. And you're not expecting them to be super high performing. But here you find ourselves in a situation where it's a high performing company with very attractive growth returns playing in a pool of other companies that have very low to moderate growth, really low volatility relative to the market. And it's a really good position to be in. Those are the kinds of unique opportunities that we generally look for. It's the risk profile that matches the right return and always focus from a portfolio standpoint in where is that alpha.
Great. And that actually leads to the next question nicely, which is, we're seeing later stage shops coming to the early stages in an effort to find this alpha and otherwise diversify. So have you seen this affect the landscape or your portfolio companies, and what's your long-term outlook on this? So this is geared towards Alejandro to speak on the early stage and then Jasmine to speak from the late stage.
Yeah, I mean, certainly there's a sense that literally everyone on the planet is a seed investor now. Hedge funds, crossover funds, late stage funds. I mean, you name it, they're all seed investors. I see them all the time. So look, you can't control what others do, where they want to put their money. It's obvious that it was difficult to find yield in other asset classes. So, hey, why not go to the earliest stages and take 20% at every single round? I think ultimately this will not stay the case long term because this is just not what they do, right? These folks are used to parsing through mountains of data to make decisions all the time. And what they're doing at the earliest stages is just slinging around money. So it works for a while until it doesn't. So the way that we view it is just like our approach is to stay disciplined, to not get bothered by the noise, and frankly, just follow our conviction. I think the biggest thing that will help the managers who are here operating in this world rise above is to truly find a way to have a thesis, be driven by that, and not care at all what any other investor thinks related to your investment decision. Because at the end of the day, you ask 10 different people for opinions, you're gonna get 10 different opinions. And at the earliest stages, we're just dealing with a different kind of experience, right? Like the signals that are there for the later stages are not there for us. We have to be more cognizant on our belief in these people as individuals, as a unit, as a company to be transformational. And there's just a subtlety that comes to that. And I don't believe that, not that they're not obviously, they're incredibly intelligent individuals, but I just think it's a different set of skills. So, as we're seeing our portfolio continue to evolve over this time, some of them have been recipients of these tailwinds. I mean, we're investing in e-commerce infrastructure, fintech, and vertical SaaS. So a lot of this has become really hot in the time that we're in right now. So it's wonderful to see for our founders, because these are not founders who are dependent on healthy capital markets to continue to grow. We're investing in businesses that have some kind of understanding of their unit economics, that they can get to cash flow break even without necessarily needing to, to be able to raise that $50 million round somewhere down the line. And if they need to, great, but they're doing it because it's actually an accelerant, not out of a necessity. And so their ability to negotiate their terms on these later rounds, they just have a stronger leg to stand on. And I think with the influx of so much money of what I'm referring to at this point, like just drive-by investors who are coming down here, because it is a great time to be in tech. It's an incredible time to be in software investing, particularly at the seed stage, right? Because it's getting harder and harder to get your check in the door. It's getting harder and harder to capture that 15% or that 10%. And so how you're thoughtful about that is by having something that truly differentiates you. And I think, again, with our firm, both my partner and I, we've been founders, right? So I couldn't tell you what it's like to be an investment bank, but I can tell you what it is like to be a founder running a software startup and having no capital and understanding what that journey is from point 0 to point 1. And that message resonates profoundly with people who are starting out a company, particularly diverse founders, right? Who still have a lack of people who look like us to go and talk to, just to even feel the sense of comfort that, like, hey, this venture investor actually has been able to sacrifice something. And so I think just that ability to be able to resonate with the founders is going to ultimately allow the best companies to continue to get money from investors who are thinking about things in a different, diverse way.
Great, Jasmine.
Yeah, I think this is a very, very important question. Staying competitive is just so important, sort of the name of the game, especially at the later stage. And what we're seeing right now is just a really intense deal environment, the emergence of these new funds, and actually, I mean, if you think about who they are targeting, they're doing a good job and they're winning into really great companies. And so the reaction that, we have had internally is really just maintaining really strong discipline into your thesis. So a lot of what Alejandro was saying, but I think there's also a lot of ways you can reorient your team towards thinking about new and different opportunities to still work with phenomenal companies and drive really good returns to your LPs. I think that this is really forcing a lot of funds to distinguish what their true differentiators are and really try to deliver that to this set of entrepreneurs that would really value that. Some of the things that we focus a lot on are around our thematic areas, fintech, digital transformation. I think that we have always been really focused on working with companies that are really efficient with the capital they raise. That was probably even before COVID, maybe, when WeWork came out, that was something that was really a big focus point and something we carried forward with us. But I also think we try to make sure that we opt into the processes where they also want really good partners. I think for us, having a good muscle memory on, how companies have done really well from Series B all the way to IPO, but all the things you may have not seen behind the scenes that maybe didn't go so well, and helping, founders navigate the different growing pains that you go through. Sometimes what gets companies from A to B isn't always what gets companies from B to C. And, the trajectory is never a straight line. And so having a partner that can really help you where you need it and also stay out of the way where you want them to as well is the type of relationship that we're looking for. And so staying, really close to your first principles and really understanding how you can drive that value to the type of people you want to work with is something that's incredibly important and something you have to articulate very early on in this process.
Love to hear it. We'll shift a little gears here with Rebecca. So we've seen more interest in investing in LATAM nowadays, especially since there are more unicorn companies and stories and other ways to generate returns. So this is your main focus. And so please tell us how you compare investing in LATAM with US startup investing in 2021, as well as some trends that you see.
Absolutely. I have to say I'm having a ton of fun investing in Latin America. We have amazing founders, and I think the pandemic has contributed to some extent to the talent pool that we have in the region. one of the reasons is that now it has become more normalized to have founders with trading in the US who in some cases got stuck without being able to come back to Silicon Valley, New York, Texas, and they built their remote teams back home, whether that's Brazil, Argentina, Mexico, Colombia, Chile. And that has created a more vibrant community of folks who are really connected to the global markets and to Silicon Valley and to capital, access to capital. So what we see is a lot of options in Latin America, many problems to be solved. And in recent months, we have seen a lot of exciting news around fintech, education, companies that are crossing some of the glass ceilings that we had as a region in reaching valuations and also access to exponential growth. So, we just don't have enough time to go through all of the deal flow. And I think that's the message to investors who are right now competing for those deals that are overpriced out of YC. And you're thinking, why are these founders experiencing the inflation of being in this cluster? If you go to Latin America, there's really, really good talent at very reasonable prices right now. And I think the sweet spot is to find those founders who have the local depth, so they're insiders in the market, but they do have that global breadth, and they could easily get into YC. And what you want to do is to catch them and invest in them right before, a few months before they do that. I'll be very honest with you. I have two portfolios right now, one in Silicon Valley, one in Latin America. And my Latin American portfolio is by far outperforming the one in Silicon Valley. And I think the reason is that we're able to get into those companies earlier with better valuations, and that the markets are just less competitive in some of the sectors that we invest in. Whereas in the US, the sectors that have potential get crowded very quickly, and you have to fight very hard to get into those deals. So, in terms of outside of Silicon Valley investing, I think Latin America is definitely a very, very high potential, high growth area right now.
Love to hear it. And I think this actually ties really well in with our second theme, which is access to capital. Actually, Adriana, I know that Clock Tower invested in Kushki, is an Ecuadorian startup. And, I just saw the news yesterday about how it just raised 85 million. So I actually want to throw this over to you, which is just, we're seeing this push for more access to capital, both demographically and geographically. So how are you thinking about incorporating this into your strategy overall? And then for other speakers, if you want to drop your viewpoints in the Zoom chat, that'd be great.
Love the transition and love that you flagged Kushki, as it was our first investment in Latin America.
And Ecuador, so.
And Ecuador, so it's one that is very dear and near to my heart, as you can imagine. It paved the way for 14 investments we have now in the region, and a dedicated vehicle, which I'm going to talk more about. But I think Kushki is a great example of overlooked talent and having the faith in, just ignoring what everyone else says, right? We saw this company end of 2019, ended up investing early 2020. It was a smaller Series A led by local funds in Mexico. Castec ended up entering towards the end, but it was not happening towards the whole formation of the round. And we were able to spend real time doing research, understanding the payments landscape, understanding how differentiated they were, and it felt like very much of a no-brainer. And now the results are showing, which is extremely exciting. And the reason why we were able to pull this trigger on a region that we had never invested in, I think, shows a lot of the DNA we're building at Clock Tower, and it brings you back to the core question, which is how we're pushing for more access to capital to underrepresented founders. And I think there's multiple dimensions to look at it in the investment process. You look at sourcing, diligence, and let's say committing, getting into a deal. On the sourcing front, we're being a lot more proactive around leveraging minority-focused networks to start getting in front of more Latinx and founders of non-minority founders. I think my heritage has made it easier to connect and to bring them in front of the partnership in a way that probably they would have never met them before because they wouldn't have been in the places where we are. And I think that's a strength of ours, and we're capitalizing that a lot. We put emphasis on hiring more female investors. We have 3 out of 5 in our team now are women. And so I think that also is important. We saw a rise in more female founders when I joined the team as the first female investor. And I think it's an interesting heuristic of diversity in investor does translate into diversity of deal flow. And we're very proud of that and focusing on that. That's on finding the opportunities and on picking. We have a very active conversation around this internally. It's not perfect, but we're trying to improve the workflow around it. And so far, some of the initiatives we're carrying on are, if there's ever a minority investor, they always get 2 calls with us. There's never just 1 call. So we make sure the whole team gets to meet them, and that we're all taking it just a step farther than other founders, to make sure that they get even more of a fair opportunity, and that we're adjusting for biases that we're not even aware of in the first call. And then, yeah, I think that's it. And then just generally, as I was saying, we try to be very open about these things internally as a team, and flagging if we ever witness any sort of bias in the decision-making process that goes beyond the actual business model or the price, or through the random dynamics that we have to fulfill also because of a fiduciary duty that we have, right? So we try to keep that in mind. And I think that's how we're thinking about it at Clock Tower demographically. When it comes to geographically, Kushi again was sort of our first experience in Latin America. And similar to what Rebecca mentioned, we saw a lot of opportunity there that was very overlooked, lots of top talent that were basically, there was this arbitrage of just lack of access to the right sources of capital in the US. And so it was like a very straightforward way to start narrowing the gap. And we did 4 investments in LATAM before we realized that we just want to do a lot more. And I think that the clearest way to commit to the region has been, we raised a dedicated vehicle. It's still open. We surpassed our cap, now we raised it, because it's been a pretty exciting strategy for LPs. And now we have a dedicated pool of risk. We're looking to back founders in the earliest of stages, Seed and Series A, from that fund. Because that's where we see the biggest gap is in getting founders off the ground, and then allowing them to build the metrics to show more.
Yeah.
So that's what we've been doing with that.
Love that, Adriana. And that actually ties in a little bit with my next question, which is around the fact that diverse founders, for the most part, need that capital at the pre-seed and seed stages to get off the ground. And so it's statistically easier really to have those diversity numbers on the earlier stage rather than later. So how are you thinking about investing in diverse founders in the later stage, and how has your background influenced this? So I'll call on Rami first, and then either Angel or Jasmine, if you guys have any particular strong opinions here, please feel free to jump in.
Yeah, I mean, I think in anything you're doing in life, the key to diversity is diversity of sourcing. And so, for us as a firm, what we found is our best sourcing mechanisms for deals overall has been venture funds. Most of my friends at kind of the old school big name venture funds mostly source from a certain subset of early stage funds. And so we source from some of the big named early stage funds, but it's also been important to us to work with a diverse group of funds. And that's not just underrepresented folks, that's folks in different parts of the country. And that's been able to drive us a differentiated deal flow. So our first deal when we launched Next Equity in 2016 was an investment in the Real that was sent to us by a startup venture VC who was a woman in New York focused on women-founded companies. And she wanted to work with a firm that had more resources than her, and that she knew that would be very fair in making sure she could also get into the deal. And so we worked together with her on that deal. We worked together with a number of other, both larger and smaller firms across the country on finding the deals that we find. One other theme I think you hear from what a lot of folks have said is, and I think as Latinos, we tend to be attracted to this, is we like scrappy founders. And scrappy founders don't always raise venture capital. And so one thing that's been helpful for us as well is being able to invest in companies where we're the first institutional check, even though they're at that 10 to 50 million revenue stage. So most of what we invest in, there has been an earlier stage VC in, but as an example, we had a company in LA where the founders, 2 women, started it on their own, and they got to that stage without raising any institutional capital. And they wouldn't be able to raise traditional venture capital because of that path. But I think being open and flexible in your business model when you find a great company is another way to attract kind of a more diverse swath of the population. But we at the mid stage can't do it with all these great early stage folks we have on the call. The reality is the majority of venture like opportunities are backed venture at the early stage. And so I'm really grateful for the folks, not only on this call, but also kind of around the country that are increasingly focused on, making sure we have access to capital for a wider swath of the population.
Great. Jasmine or Angel, either one of you can also take this question.
Yeah, I'd love to just add a couple of additional points. First of all, proud to say that we actually just let a deal with a diverse founder at the later stage. It's not announced yet, but I will be singing it from the rooftops once
maybe. I don't know. drop it into the chat, maybe.
Yeah, maybe. I mean, I'll be recruiting everyone here to work there. So, but one point I do want to make is that I do think CEOs are thinking more than ever around diversity at the later stage, because if you want to be a competitive public company, you need to have a firm point of view around this. And you also needed to have been investing in this 2 to 3 years ago anyway. And so I think that on the entrepreneurial side, a lot of the funding behind diverse founders will happen at the earlier stage, but we should not be remiss in sort of trying to influence also at the later stage. And what that means is, at least in my mind, is really trying to build that ecosystem in that community. I was able to work with one of the amazing seed investors, Alejandro, on this panel, to work with one of the founders in his portfolio and ultimately, lead one of their deals. It was an incredible act of teamwork and really trying to move forward the needle on a lot of initiatives that we have so much alignment around. The diversity rider, he'll talk a little bit about that, but that has been happening. A lot of activity at the earlier stage. I think it's just as applicable at the later stage. Board representation. That is another big area where we can pull in from our communities to start to be a part of these VC-backed conversations. The conversations within VC-backed companies is very different than having them for public companies or private equity-backed companies. It's all still within the network. So having someone there where you can really influence is really important. And then lastly, I would say getting great diverse operators and talent in these rocket ship companies. Allowing them to be able to have access to this incredible network and building that is really important. So I think that it's important to just understand connecting all of the dots of the entire life cycle and really trying to, I think only then can we really try to work together to move a lot of it forward. And I'm really optimistic based off of, all the amazing people here on the panel and what the initiatives are that they're spearheading.
That's great. Thank you so much, Jasmine, for that. And that actually ties in really nicely to the third theme that we're about to tackle, which is long-term economic inclusion, as well as generational wealth. So for those of you that have raised your own funds, how have you seen funding for diverse fund managers change over the years? And just to give some insight, what do your LPs do best that you appreciate? So I'll start with Rebecca first and then Rami.
Thank you. Well, let me first say that even though the direction of change is the right one, we still have a lot to do. And this is applicable to Silicon Valley as well as Latin America. When I started fundraising, my first fund in 2014, the numbers were 96% of all the decision-making partners at VC firms in the US were male. So we were just representing 4% of the ecosystem. I think today is closer to 10%, which is not enough. And in Latin America, I don't know the most recent numbers. I think there are a lot of studies ongoing right now where efforts of diversity and inclusion are really accelerating in the region as well. I think the conversation about diversity has taken two different maybe angles. One of them is the perspective of what the market wants and the liability that is involved in, for example, having a team that doesn't understand that market, that consumer, with cancel culture, with Me Too, with all of the social equity movements that we have in the last 2 years. Ignoring diversity and inclusion is a liability, and it's a bad, poor business decision. So that's one strategy that has worked in creating more representation and inclusion. But increasingly, I do feel like many of the investors, female investors and minority investors in Latin America and in the US are feeling conflicted about this sort of fake it until you make it principle. Like, is it enough to just have the numbers, or do you really need to change the culture of the organizations to believe in creating influence and true empowerment of the minorities, and especially women of color who experience intersectionality, in having true influence in the decisions on where the capital goes and what type of companies actually get to create products that are more representative of the markets. And we are at a transitional place in that. And I think, you asked the question of what do LPs do sometimes. We have the same problem with the LP base. Most of them are not very diverse, and the best ones will try to nudge GPs to think broadly about diversity, and not just in terms of quotas, and you have to have certain members as part of the team to look good, but truly nudging people to do diagnostics for the team and culture and value alignment exercises where you can identify some of the most insidious and subconscious biases that you may have. And the biases affect all of us. Like, as a woman of color and VC, I have my own biases that I probably don't know about. And so I think, the nudging has to happen all the way from the source of the capital, from the LPs to us, the GPs. And when we meet with companies, I'm pretty obsessive about asking about this diversity question and how they have these discussions internally. And I think, as the more frequently they hear these questions, the more awareness is built, and they start thinking about real cultural shift and not just, how to look better and have the right pictures for PR purposes.
Yeah, when we founded Next Equity in 2015, 2016, diversity really wasn't talked about much. We didn't even think about any kind of diverse focused funds to try to invest in us. As you look into, a couple of years after that, you saw the Me Too movement start driving some conversation around diversity in terms of gender diversity is becoming very obvious when everyone in the room is a man. And, people just hadn't thought about it as much. And then really last year, you saw, more ethnic diversity come into play, driven in large part by the realization of the underrepresentation in a lot of the challenges the Black community has faced in the U.S. But, as Latinos, we have to be candid. We are also benefiting from a lot of the underrepresentation of the Black community and the focus on that, because people are saying, wow, there's, Black folks are very underrepresented in venture as a percentage of the population. Oh, and by the way, Latinos are as well. And so, I think it's very important as we're still in the early days of diversity, but people are actually doing real things now. I don't want to celebrate yet, but I think it's important as we think about diversity that all three coalitions kind of work together, because the reality is we're still underrepresented across all three of those. But a lot of it's going to be driven, as Rebecca mentioned, by LPs. The best way to make a VC do something is for their LPs to suggest it. But the other way is by founders also pushing in. You're seeing founders increasingly care that the folks they work with, have some diversity on their teams. And then you're seeing bottoms up. You're seeing a lot of young leaders in the women, Black, and Latino community come up, and new efforts come up as well. So It's pretty early days. Latinos are still only 1 to 3% of VC versus 18% of the US population. But the attention, I think, over the last couple of years is finally there. And the challenge will be getting enough folks to be able to build a track record so that even more, and get a chance to build a track record so that even more LP dollars can come in over time.
Yep, you're right in the sense that it really is about investing in diverse founders and making sure that also diverse investors are on the other side of the table, and that we do get more Black and Latinx and just overall POC representation. So with that, it's just amazing to see most of you as Latinx investors raising your own funds, joining mega funds, and really creating new initiatives to make sure that those that benefit from exits include our own people. So Alejandro, can you tell us a little bit more about this diversity rider initiative and movement?
Yeah, look, I think there is a big effort, obviously, in investing in diverse founders, but at our firm, we also invest in white male founders as well. And there is an ability to make sure that even when you're doing that, that the overall deal ends up diverse by remembering that you can bring in co-investors who are from underrepresented historical backgrounds and have them be a part of that journey. And the way you do that is by having a conversation every single time you do a deal for a startup. Full stop. It doesn't matter if it's early stage, if it's a male or a female, or what color that team is. There is no limit to how much diversity you can have on a deal. And that is the essence of what the Diversity Rider Initiative that I created last summer was all about. So effectively, when George Floyd was murdered, I went through a pretty deep grieving process as I just kind of thought about my life coming from poverty, being a founder in 2009 in LA, where there was nobody that looked like me. And the only people that I met were not willing to give me even a modicum of advice, much less capital. So spending 7 years feeling that through 2 different companies stayed with me. The 6 years of raising a first fund of 20 million, which was incredibly hard. And then a second fund of 23 million, which at the time the conversation started to change of like, oh, hey, we want to meet with, diverse emerging managers. And then I'd show up and then it's like, oh no, but the bar for you is still here, right? And so this essence of what people were saying was not real once I started to show up to the room. And that all kind of came to a head. As I was dealing with this pain. So this idea came into my mind, which was to create language that I could create that would be broad enough that every time we would do a deal, its call to action would be clear, but it wasn't enforceable from a teeth perspective because it needed to be up to that particular founding team and that investor to have that conversation as to what appropriate amount of capital would be allocated for diverse co-investors, whether that's on a percentage basis or whether that's on a dollars basis, but making sure that we're having that conversation. And so that's what the call to action was for the Diversity Writers language that we created. What started with what felt like moving a boulder up Mount Everest in the summer by myself, locked in my apartment, trying to do something to convince a bunch of investors who really, there's no incentive to do that, right? Like if you built a firm and you got a brand, why change, right? Business is good, but you have to realize that the overall movement, that the world has changed and there's a large group of people who have historically been left out. And it's on us, particularly as the folks who have the capital and deploy that, to make sure that we have that conversation so that it's no longer just make sure your board is diverse and make sure you have the right practices so that when you're hiring, it's like, well, what about the actual cap table where you create generational wealth? How about that conversation? And how about we start from there when we're talking about who we're bringing into the round? So we launched with 10 firms, including Greycroft, First Round Capital, and Maveron. What I hoped would resonate to some sense in a broader community has gone well beyond what I could have imagined at this point. We're now at over 50 firms that are signed on using this writer's language every single time they're doing a deal, ranging from early stage to later stage. Cooley, as a law firm, has adopted this inside of their organization. They've used it in hundreds of deals now that have been done through Cooley in and of itself. And we're just taking this to the next level. So everything to me is about providing access, creating wealth for individuals who have been left out. And a lot of times that means that the people who are at the forefront of that, we're not really going to be the recipients of all of that hard work. And I just think that that's okay. Like at some point, we have to make the conscious decision of what kind of world do we want to live in, and if we're going to do the hard work to create it. And yeah, a lot of times that means you're going to be the one slogging through the mud, But if you know that there is a greater purpose to that you can take what you've learned, take the platform that you have worked hard for to develop, and turn around and open your hand and bring others behind you, I think that's work worth doing. And so we're seeing a lot of firms that are doing that. We're seeing founders now that are taking this message and that are basically showing up to the negotiating table, telling potential lead investors, we're not going to allow you to invest in my company if you're not okay with me carving out a portion of the total round size for diverse co-investors. And so that's how we're going to help individuals who have been left out to build track records, to make them more desirable targets for a lot of institutional LPs who, for better or worse, right, are still looking for some of these signals that has always been around in terms of how they decide to invest in companies. Oh, that's cool that you invested, but did Andreessen follow on? Did Bessemer follow on? And again, I believe that this is a long-term game that's going to take a while for that to sort of change, but we can do things, we can do the work to start to help people get into companies that are financed by firms on those levels, and start to build those track records, start to have collaboration, and ultimately create a better world.
That sounds good to me, especially at Republic. Hopefully we're getting non-accredited people as well into these cap tables. But if you can please drop your links in the chat for folks that want to learn more or how they can support, please feel free to do so. And so actually this is our final question, because we are going to wrap up in a second. So for everyone, and in alphabetical order, what are you optimistic about really with regards to funding diverse managers or entrepreneurs? So alphabetical order is Adriana, Alejandro, Angela, Jasmine, Rami, and Rebecca.
I'll start off with, I guess that's two things. So one, I'm more bullish on the power of community than ever before. I think being included in groups that focus on helping women and Latinx be better investors and find better opportunities have definitely helped me as a launchpad when I started in venture. And I think even comparing to when I started 3 years ago to today, it's getting stronger and stronger and gaining more recognition. I am very bullish in the ability of these groups, such as VC Familia, to be honest, in helping more people make it to the next stage in investor scale. And then the other one is I'm confident there will be a wave of minority successful founders that then go on to do more angel investments or go on micro seeds and help funneling a more diverse pool of seed investments, which I think are truly the foundation for diverse growth, equity, and everything else to come.
Alejandro?
Let me give a second shout out to you, Cheryl, and the work you're doing at VC Familia. I just think it's really important, right? Like the sense of building community is the way that we rise together, because there's very few of us that are out here that look like us. I believe that's going to continue to change, but the work you're doing there and the work that Rami's doing at Latinx VC is incredibly important. I just think the future is diverse, and we're going to be living in a world where I believe in the coming decade, we will see firms that will live alongside the Excels and the Sequoias of the world, but built from the ground up with diversity, where the majority of the employees are diverse, where the bulk of the portfolio is diverse. And I believe they're going to be the ones to win the alpha. I just think that this conversation has changed dramatically. It takes longer for the sources of funding to kind of follow along with what's happening, but I don't believe that this message is going to dissipate into the wind anymore. And so there is an incredible opportunity, unlike any other that I've seen in working in tech now in like 12, 13 years or whatever it's been. And we're just starting out. We have a long way to go. I don't get lost in what comes out every quarter of like, oh, record-breaking dollars deployed and all this and that, because you comb through the data and you realize, yeah, but that's not going to diverse people. That's just going to the same homogenous group. And it's actually just getting put into multiple rounds in the same like small set of companies. So there's still certain ways that venture has been practiced that has not changed and that the pandemic has exacerbated. And it does make it harder for people that are diverse to compete with that. But this is a long, hard game. No one ever said getting into venture is going to be easy. And so I just think that there's different ways to find access to capital, revenue-based financing, debt financing, crowdfunding, angel investors. All of that is going to give a rise to a large group of people who have been overlooked And then we're going to continue to have firms that are led by people like all on this panel that will become partners, that will leave where they're at, that will raise their own firms and just do things in a different way. And I believe I'm an optimist at heart, and I believe that's where the world is heading. And we just got to do our part to make sure that we get there.
Great. Angel?
So I think it's pretty well documented that pushing the tools of innovation closest to where the problems are usually leads to much better solutions and much better growth. And it's extremely important that we also build the investor community on top of that, right? So it's the creation of wealth, it's the sharing and the spreading of that wealth, and it's the reinvesting of that wealth to continue to grow. An anecdote that kind of displays some of that, a good friend and founder that I've been supporting for quite some time, Roy Sosa, he was Mexican-American, founder of Netspend. I don't know if many of you guys know Netspend, but Netspend was the company that created prepaid debit cards as an industry in the United States. It was an old company. When he was pitching to people, he said, look, the Latin American community, they need prepaid debit cards. They don't have access to credit, etc. Most VCs just didn't get it. When he changed the story and said, hey, this is going to be the financial instrument for your teenagers to learn how to manage their debit, and because they don't have access to credit, a lot of VCs were like, oh yeah, we get that problem. But it ended in that limited sort of mind frame of the United States, mainstream sort of white kids that they didn't have access to credit because they were too young. I'm so happy that 10, 12, 15 years later, now we're seeing a huge revolution in fintech, not only in the US, but everywhere in the world. And those are examples that we can continue to replicate with lots of other examples, right? One Medical, another company we backed, and I'm a backer of Mi Salud, who's trying to do a One Medical for Latinos kind of situation. So lots of things that we can work on, and it's not just for Latinos, but every other underrepresented community that knows problems intimately and will now finally have the tools and the capital to solve that.
Great, Jasmine?
I will keep it very short and just say that despite what these statistics say, I do believe it's never been a better time to be a diverse emerging manager, an entrepreneur, or writing a check supporting one. I really do believe we're reaching a tipping point. It will take a while to see, the seeds we're planting today and the changes from those, but I think that it starts with building the right community, working together, and starting to see these changes happen end to end across the entire ecosystem. I do believe that we're making strides. There's a lot of work to do. So if you want to be involved in any of this, we would more than welcome more people joining a lot of these initiatives, but I'm really hopeful for what's to come.
Love it. Rami?
A few quick points. One, there's way more Latino founders who are killing it. Today, Outreach got a $4.2 billion valuation started by Latino founder. There's been exits like Tom Chavez at Crux, Salesforce, $700 million. I remember when Alex, Angel, and I were on this panel 6 years ago, those weren't the case then. There's a lot more VCs now. I remember we were 3 of the few back then, and look at this great next generation across all the panels today that we have. And then there's a lot of community efforts, both outside of the Latino community, but also in our community, whether it's the Diversity Rider, VC Familia, or Latinx VC. And so none of that existed when we did the same panel 6 years ago. And so that's huge progress, and I'm very optimistic about the future.
And this off, Rebecca.
Yes, I know we're out of time, so I'm really optimistic about the future generations. I teach at Stanford and Thunderbird, and the 20-something-year-olds, Generation Z members, have amazing value systems. They believe in sustainability, in social equity, in gender equality. So that makes me very optimistic because they drive consumer behavior, and we're heading in the right direction. They're creating and demanding change, which is amazing. And I loved watching the Oscars this year because some of the winning films like Minari do tell the stories of immigrants and people like us with very diverse backgrounds. And I think, now the society at large is appreciating the contribution that people like us can make in many, many different areas of business, but especially in innovation, entrepreneurship, and investing. So that's all good news.
Great. Well, there you have it, folks. Thank you so much. We're working hard to change the status quo and make sure that the future is diverse and equitable. I hope that next year, if you all have me, we'll all see each other in person. But yeah, please feel free to reach out to the panelists. They have put all their LinkedIns and kind of ways to get in contact, maybe their emails as well. And yeah, this has been a wonderful panel. Thank you so much again, speakers, and everyone. Have a wonderful rest of your day.